right. Welcome back. Welcome back. Welcome back. And again, welcome back to another episode of Take Profit Tuesdays. This is your host, Levon Stewart. And as always, I just like to begin every single video. Again, guys, this is not financial advice. This is strictly for education, entertainment purposes. Again, if you're not involved into the markets and you don't have the threshold to handle all the volatility, um, and if you choose to, you know, talk to a broker or have to pay a commission, if that's something in your playing field, then yeah, you could definitely do that. But that's gonna have to find someone who's licensed, someone who registered with a broker, and yeah. But on this channel, we teach you how to trade. We teach you how to pay those commissions. We teach you how to be independent. That in line with the four pillars, you're unstoppable. So, with that being said, I want to begin out today's episode with the S&P. So, from last week where we left off, you could really say we really didn't move that much. And what it could be a setup for something that's gonna happen in the next couple weeks to months, right? And we're gonna go over a couple fundamental news. We might do the forex. See where the buys and sellers are. But let's see. I don't want to upload too much to you guys. I want to keep it concise, short, and consistent. This might be a relatively medium-sized stream. But anyways, from last week, we kind of, as far as technical goes, the price has kind of still in that consolidation zone. I have not changed anything. I have not done anything yet. I was actually thinking about possibly, I don't know, maybe next week, before next week episode or after next week's episode, to get another buy position. I'm thinking like a relatively less aggressive amount. Not really in a rush for anything else. So yeah, like we always talk about the psychology of things, the strategy and the risk management, and of course, pillar one, the capital. You kind of have to all play these online. If not, then you're really gonna have a hard time with standing these markets. And just to put things in more perspective, we're looking at the daily chart. I'm gonna pull up the weekly just to show you how long we've been doing this for. And this is episode 20. So shout outs to y'all who's watching this. Shout outs to y'all who's been supporting since the rip. We're gonna make more episodes. We're gonna keep growing. We're gonna hit that trading that options account so we could all practice options and make more money, right? So why not? So again, we're kind of hitting a significant dip, or we're in a significant dip. Some are calling it a recession. Some are calling it worse than the COVID dip. Who knows? Who knows? But you could all thank inflation for that, right? You could all thank inflation, because let's be real, with prices of goods and everything going up, you people have to, if prices and goods and services are going up and people are out of jobs, or there's a significant of people who are not working, and the next shift of workers are the ones who are retiring, are going to start putting out their 401ks, and they're going to be opportunistic. Well, not really opportunistic, but yeah, fearful. They're going to retire early. They're going to cash out their 401ks, which sells a significant portion of the market. And it's kind of what's to be expected after after the whole stimulus and everything else on the third. 1 second. So, even though these occurrences are happening today and in real time today, we're gonna look back 6 months from now, 8 months from now, maybe a year or two, and just be so surprised. Oh, Lee, oh man, you're so right. I wish I had these four pillars all together. I could have had like a bag. Instead of spending that $1,000 on whatever the case may be, I should have put in crypto. I should have put it in um the S&P, the index, get some dividends. Put in like a staking project in the crypto market. Those are the kind of things you kind of want to be opportunistic with, especially if you have for instance, a large sum of money, just on the side, when to either, get into, money you don't really know what to do with. You kind of want to see how, you know, should I buy a house? Should I put in real estate? Should I put into this? Should I put into that? You really have to really play your options. And again, if you're not playing your option, you're not being opportunistic when people are being fearful, like right now, you're thinking, oh, the market's going down. Why would I buy when the market's going down? Yeah. As far as trend goes and short term goes, and if you're a day trader, you know, yeah, those are things you have to consider, right? Because again, if you're these are things that we kind of teach in the program that we have at Vonnie Effects. We teach the three different types of strategies: the day trader, swing trader, and the investor trader, or the investor to begin with. So we teach all these strategies, and right now I'm teaching guys how to become investors, just off the S&P only. And by the way, there's so many projects, investment assets, classes you could get involved in and participate in. But we're just gonna stick with the basics, guys. We don't want to get you, overwhelmed now, right? Especially if you're just not watching this. And again, if you're just not watching this, make sure you like the video. Make sure you subscribe. Make sure you follow the channel. You know what I'm saying? So with that being said, let's talk about some fundamentals, right? But before we talk about fundamentals, I want to talk about Bitcoin really quickly. So I've been hearing in these streets, and when I mean by streets, I'm talking about people I know. I'm talking about conversations I'm overhearing. Yes, I'm being nosy. I'm talking about videos I'm seeing, this, then, the third. I'm talking about conversations I had with people, and come in conclusion, what I've come to find out is that people are losing faith, right? People losing faith. They're just, man, Bitcoin is not a great asset to buy. Wait, let me clear this up for you guys. Wait 1 second. Oh, hide all drawings. All right, there we go. Yeah, Bitcoin is such, not a stable asset class. I heard one guy say how or Warren Buffett reference. I'd rather put my money into land than into a digital currency. I'd rather put into a tangible asset or something that's tangible behind it. And in retrospect, yeah, you could believe him. You could agree with him. Yeah, he's somewhat right in my opinion, as far as the fundamentals go. And if you think about it as well, cryptocurrency is still a new asset class. It came on, don't quote me, but what, 2013? So with that being said, now one could believe that if an asset does not have a let's say stable track record of it, let's say for instance growing like the S&P 5% on average every single year annually, right? Now one could say that Bitcoin has a zero return on average. Now let me stop. Not a zero return on average, but a very high, significant, exponential um return from inception, right? But guess what? The on average aspect now, it's not congruent because again, we're not investing into companies that are relatively what I would like to say rinse, wash, repeat. So for instance, now just to give a good example, I'm a company. I make a lot of money. For instance, right? I have 50 employees. I'm at the peak of my business, but yet during this peak, I'm being slowed down. I notice my workers they're not working hard enough. My materials. I'm gonna do a rinse, right? So I'm gonna wash. Probably fire some people, do things different. Stop that. Hold on to this. I'm gonna wash it. What's that? What's washing it? I'm gonna delete things, and then I'm gonna repeat how I created new things afterwards, and I'm gonna repeat that again over and over and over. So during the rinse, wash, and repeat, you may have a significant drawdown, and then as you're repeating over the cycle of being a good company, different products coming out, a brand rebranding, all these different things. I'm not gonna get into too much details because you could talk a lot about these rinse, wash, repeats, especially now. But it's just the idea of how this could play also in the markets as well as Bitcoin, and that you really have to be careful during times like this when people are very, very fearful. Because again, guys, we talked about the four pillars. So if you're not, if you don't understand the four pillars, you get washed. Well, in any market, to be honest with you, it could be an 08 if you're in the stock market, your account drops 30%, right? You're like, oh, I gotta sell before it drops to zero, right? So now switches to the more risky assets, right? Not really investing into countries and companies. You're really investing into a decentralized community, or what I like to call it the global currency, which computers, people could accept. And not to go too much into a spiel now, um, this volatility now is not something tangible. It's all code. So being it that big could be code, it could have a lot of errors, such in a third. The risk wash repeat cycle could be more volatile than the stock market or any other forex or any other particular asset class that we're used to. So with that being said, keep that in mind when you are investing in these markets, because again, guys, you need the pillars. So really quickly, we'll transition into some fundamental articles, and again, we're only 13 minutes in. If you're just not joining in, make sure you like the video, subscribe. Again, we do these every single Tuesdays. They're called Take Profit Tuesdays. We literally talk about making money. Like that's the name of the game. And again, if you have any questions, throw them in the chat, in the comments. And let's build, right? So I'm not gonna get too much into these articles. I just want to touch on a couple points on each, and then summarize, right? So shout out to Inez Fury. She writes, titled Inflation. Online prices slow in June, shows Adobe data. Right? Online prices for customers slow in June, with electronics and apparel seeing prices decrease. So why would electronics and apparels decrease? Are people not having enough money to go shopping? Or are people reducing this what's the word I'm looking for? Discretionary expenses. So Adobe Digital Price Index shows prices for online goods grew 0.3%. Oh, okay, so that's the reason why no one's really buying as much, because they're increasing pricing on an annual basis, but decreased 1% on a 1 month over month basis. June is the third month when online prices have slowed. So again, they're trying to keep up with this demand. Electronics and apparel took a hit, with prices in those categories decreasing 7.4% and 0.10% year over year, respectively. Apparel costs for customers decreased 4.06 from the prior month. The decrease in these two categories is helping drive down overall online inflation. So yeah, if you're decreasing the pricing, yeah, it will also help customers buy more. kind of balance out, kind of have the economy still stimulated relatively, and be able to withhold itself. But as you can see, based off this chart, where inflation is and isn't. 12-month change of price. So yeah, inflation is a change of price in goods from price, from year to year, month to month. And as you can see, transportation is almost the top three, right? Gasoline, airfare, transportation, hotel room, household energy, used vehicles. You see, I was looking to buying a motorcycle, and I can't. Prices are high, which is relatively makes sense because people are moving, people are traveling. These are the industries that are making a lot of money. So, but guess what went down in price though? Rental cars, IT hardware services. That's where you need to start putting your money, guys. These industries, or start buying with cash. At least you're buying at the low. Um, yeah, we're on that there. Got the shot to Ines. Next we got Ronda Lee. Housing experts, home buyers are hitting the brakes. Ooh, we gotta talk about this now. Sellers once in the driver's seats fielding binding bidding wars are reducing their asking price while more buyers are backing out of deals. Why are buyers backing out of deals? Why are sellers reducing their asking price? Guys, you have to ask these questions because the feds they had a meeting about this a week ago. The housing market had absolutely shifted and buyers have been hitting the brakes in June. Jeff Tucker, an economist at Zillow, told Yahoo Finance it suggested buyers are finally including contingencies in offers they made this spring, which gives them the possibility to opt out. Why are these buyers opting out? You gotta ask yourself these questions, guys, so you could connect the dots. In June, oh crap. In June, if we could highlight, in June, approximately 14.9% or 60,000 home purchases under contract were canceled, according to the Redfin report, while 7% of homes for sale had price drop at high for the records dating back to 2015. Another Redfin report. Think about it, guys. The feds, they just increased the rates, bro. And now it's at that 60,000 people that were in deals, under contract deals for home purchasing, were canceled. They opt out last minute. They opt out before closing. Right? Think about that. The feds increased the rates. So now this will spin into what I'm gonna talk about next in the second after. Yeah, I'll talk about it after this article actually. And that the 7% of home sales had price drops. So now the asking price that the sellers are giving, it's dropping. It's dropping. So the housing market's coming down now, guys. Remember what's going up? Everyone's buying, prices going up. The rates are low. XYZ and the third. Now we're gonna see rates go higher and the pricing go lower. It kind of works inversely. Next, so the culprit. Mortgage rates that are 2% points higher than the start of the year, with major up and down movements in the last 2 months. The 30-year fixed mortgage rate dropped to 5.3 last year from the 5.7. So mortgage rate, 30-year fixed rates are looking relatively more attractive. Rate inflation means that unless buyers lock in rates, those who once qualified might become ineligible as rate increases. So meaning that take a step back. I'm a buyer or seller. We're both on the contract. We both have the mortgage, originated. We have a rate for that loan for the purchase of the house, right? As time passes and we don't close the house, the Fed between on the me being under contract or we're under contract and us closing, the Fed might have a rate increase. So now a lot of times they're gonna have contingencies in those contracts to have the buyer opt out, which they just talked about. So, which also, again, if they have that contingency, it makes it more attractive, especially times like right now. Because if you're gonna be a buyer, and you're in what I would call a dead still contract, where if you sign it and if the rates increase and you can't opt out, you're kind of stuck with the increase, and everything changes. So now your whole calculation changes, and payments changes, so on and so forth. It's collateral effects. So this is interesting. It's affordability, higher mortgage rates, and higher home prices mean that the typical mortgage payment is up over half. Mortgage payments increased by half, guys. About 60%. That's insane. A lot of buyers can't afford that or heard the bad news from their mortgage lender that their mortgage rates are today. You can't afford this house. So that's the honest truth, guys. And I wanted to correlate with the what we see with the dollar itself, because this is news coming out now. And let's put the DXY. See what the dollar's doing. Ooh, in my opinion, not looking too good. Not looking too good. Oh, Lee, why is it not looking too good? Because it's still increasing in price. The inflation isn't still happening. But now, let me stop what I'm gonna say now. And at this point, even though we might see the rates, well, even though they say the rates are increasing, the people are backing out of deals, prices going low. These are fundamental things that's going on. The Feds might still increase rates, guys. If things are not gonna happen overnight, I did expect some kind of change, but the momentum, as I'm seeing from the charts, is still increasing. So something must be going in Europe or what have you. And in the same breath too, the market itself, the stock market, people are not investing back, putting their money into the market. So as DXY still goes up, the S&P still goes down, and prices of gas and oil and food still goes up. So it is nice to hear that these deals are not closing, and it's slowing down money. And then the Feds, if people are getting in those deals, they're gonna pay a serious high interest rate. And if they're ready to take that premium, that's fine. That's fine. It'll help out the economy itself. Um, and relatively, it's supposed to make the money back into the stocks, and so on and so forth. So people can start, instead of spending their money, could save and invest it, right? So next we got and shout out to Rebecca Chin. Oil prices could take a spike over 150 a barrel, energy analyst says. We'll talk about this briefly. So it says the national average of a gallon of gas fell to $4.66 on Tuesday, dropping 30 cents since May 22nd or May 2022. However, some analysts believe that the recent relief in oil prices is only temporary, which could be true. I think a lot of this, especially for oil, is going back to Russia, and I think we're going to see a supply appended, if not at the end of the year, if not before. I think that it has potential to cause oil prices to even spike higher that we just saw a couple months ago. And with that being said, guys, I definitely do think as soon as summer to winter time comes, guys, demand for gas and oil is going to increase. So things need to get under control very soon. Those reserves, man, tap into those reserves. All right, so another oil topic, and again, shout outs to Miles Yud Lad. He titles this one "The Stock Market Live Updates: All Collapses, Stock Slides Ahead of Inflation." Right? I think this was on Monday. This came out. I lied. This was last week Tuesday, but I do want to still talk about it. So it says, we'll talk about it briefly. We're gonna assume, guys. U.S. stock fell sharply for a second straight session to Tuesday as investors brace for June inflation data. The commodity and currency markets were focused for much of the trading day, with oil pricing under duress and the dollar inching closer towards breaking parity with euro. By the way, the euro is dipping severely. Um, the S&P and the Nasdaq Composite each closed down nearly 1%, while the Dow Jones um, industrial average shed 190 points or 0.6%. All three index saw losses accelerate in the final hour chain. Yeah, so all these markets, they, as we already talked about in previous videos, they all kind of move relatively the same as far as huge news events that could change pricing and things of the third. Um, but yeah, you really have to be prepared for these kind of things and not be scared of what could happen and be opportunistic and be strategy. You have to have these. I can't push it enough, and this is why you guys need to join the Vonnie Effects membership. Because again, we teach all these pillars. Because if you have a strategy, right, and the capital, you don't have to put any psychology or risk into anything. Because all you're doing is building cash, and you're waiting on the perfect time to buy. So what is there to lose at the end of the day? Times like this, you want to buy. You wouldn't want to buy as it's going. Well, if your dollar cost average, yeah, you want to buy as it's going up. And even now, if you're still dollar cost average, you probably want to wait and go to another buy or buy as it goes down as well. You kind of have to pick your own poison, right? But we have our strategy here at Vonnie. So with that being said, guys, thanks for coming to the video. Again, if you're just not coming in, like it on the way out, hit the sub, and I'll see y'all next week. Peace.